The nation's once booming real estate market has reached a standstill. Deflation has set in China. Direct foreign investment is declining. Likewise, exports. What is going on in China? Today we are going to discuss the current state of the Chinese economy and why it may be going down. Chinese consumers were mainly left to fend for themselves during the COVID-19 pandemic, in contrast to consumers in the West, and the retaliation spending frenzy that some economists anticipated once China reopened never happened. Additionally, as important trading partners struggle with growing living expenses, demand for Chinese commodities has been declining. Both the global financial crisis of 2008 to 2009 and a potential capital outflow scare in 2015 raised concerns about the state of the economy. China restored confidence at that time, among other things, by giving infrastructure investment a startling rise and promoting housing market speculation. However, the property bubble has burst, and the infrastructure improvements have generated too much debt, creating hazards to the current state of the economy. China only has one other source of demand to experiment with: household spending, as debt-fueled investment in infrastructure and real estate has reached its peak and exports are falling in pace with the global economy. This slowness differs from others in that regard. If households are persuaded to spend more and save less, and if they do so to such an extent that consumer demand offsets deficits in other areas of the economy, then China is more likely to recover. Even before COVID, household consumption as a share of GDP was among the lowest in the world. Economists identified this as a critical structural mismatch in an economy that relied too much on debt-fueled investment. The lack of investment enthusiasm in the private sector and China's entry into deflation in July are both attributed to weak domestic demand, according to economists. Deflation has the potential to exacerbate the current economic slump and increase debt issues if it continues. The gap between investment and consumption is wider than it was for Japan before the start of that country's lost decade of economic stagnation in the 1990s. Some economists have warned that China may find it difficult to reach its 5% economic growth target for 2023 if it doesn't increase government spending as a result of recent weak data readings. Even though 5% is still significantly greater than many other major economies would see, experts say it is still a disappointing growth rate for a country that invests nearly 40% of its GDP annually, or about twice as much as the US. Given the high amounts of municipal debt, there is also concern regarding the government's willingness to implement significant fiscal stimulus. The basket of measures that China has committed to reduce the risks associated with local government debt are likely to include special bond issuance, debt swaps, loan rollovers, and something that Beijing really detests: using funds from the central budget. China's local governments are crucial to the country's economy, and Beijing has given province and city leaders lofty growth goals to accomplish. However, following years of excessive infrastructure spending, declining land sale profits, and rising COVID costs, economists claim that debt-ridden municipalities now pose a serious threat to China's economy. Chinese leaders expressed concern last month about a potential chain of municipal debt defaults that might shake the financial system by promising to aid with debt relief without providing any specifics. When Communist Party leaders sought strict control of local loans in April, economists viewed that message as being less beneficial. They claim the message is that Beijing has realized it needs to urgently pour money into the issue. That might be a significant step forward in finding a solution to China's municipal debt dilemma, because Beijing has long insisted that local governments resolve their own issues. Gu Qianyong, professor at Beijing's Central University of Finance and Economics, explained the Politburo's directives. The local debt problem is complex. You cannot simply say you don't want to take responsibility. Stress in the real estate sector, which makes up approximately a quarter of all economic activity, makes it more doubtful that policymakers will be able to stop the slowdown in growth. A few experts caution that investors will need to adjust to significantly slower growth. Some of them even mention the possibility of stagnation similar to that in Japan. China is approaching a period of substantially slower economic growth, which raises the terrifying possibility that it may never become wealthy. The second largest economy in the world is expected to disappoint its leaders, its youth, and much of the globe whether it continues to grow at a steady rate of 3 to 4% per year, or, as some analysts predict, flirts with lost decades of stagnation, akin to those experienced by Japan. The goal of policymakers was to close the development gap between China and the US. Young Chinese students attended universities to pursue careers in the advanced economy. Latin America and Africa rely on China to buy their products. According to Desmond Lackman, senior scholar at the American Enterprise Institute, it seems doubtful that the Chinese economy will overtake the U.S. one in the next 10 to 20 years. When youth unemployment is already above 20%, he anticipates growth to fall to 3%, which will feel like an economic recession. Additionally, this is not good for the rest of the world economy, he said. Japan's GDP per capita was already higher than the norm of high-income economies when it started to stagnate in the 1990s and was getting close to American levels. However, China barely just surpasses the middle-income threshold. However, other economists assert that given youth unemployment rates above 21% and deflationary pressures pushing on profit margins, many consumers and small companies may already be experiencing economic suffering on a par with that experienced during a recession. To relieve pressure on their profit margins and free up space to lower borrowing costs for borrowers, including by decreasing mortgage rates, major Chinese banks reduced interest rates on a variety of yuan deposits on Friday. While policymakers believe that lower rates will increase consumption, economists warn that this is not the case because of the concomitant deposit rate decreases, which shift money from those who save to those who borrow. The long-term effects of resource transfers from the public sector to households would be more significant. Rate reductions could increase the likelihood of the yuan depreciating in capital flight, both of which China will be keen to prevent. To combat pressure on the yuan, China's central bank announced on Friday that it will reduce the amount of foreign currency that financial institutions must maintain as reserves for the first time this year. In an effort to moderate the rate of recent yuan depreciation, China's central bank announced on Friday that it will reduce the amount of foreign currency that financial institutions must maintain as reserves for the first time this year. According to a statement posted online, the People's Bank of China, PBOC, would reduce the foreign exchange reserve requirement ratio (RR) by 200 basis points (BPS) from 6% to 4%, starting on September 15. With China's FX deposits at $821.8 billion as of the end of July, that would effectively release $16.4 billion in foreign exchange. Following the news, the yuan increased in both domestic and international trade to three-week highs. In the early Asian session, the onshore yuan rose to a high of 723.60 per dollar, the highest level since August 11, before settling last at 725.42 as of 2:20 GMT. To improve financial institutions' ability to use foreign exchange funds, according to the PBOC, this action was taken. According to traders and economists, the FXRR reduction should help slash dollar funding costs in the interbank market and lessen downward pressure on the yuan. However, they cautioned that it was unlikely that the action would reverse the yuan's trend towards depreciation. Rather, they saw it as a signal to the markets that the government intended to lean harder against sudden yuan losses if necessary. According to Ken Chung, chief Asian FX analyst at Mizuho Bank, the FXRR cut will help ease the yuan depreciation pressure when the PBOC's fresh round of monetary easing is underway. The reduction will increase policy flexibility for future interest rate reductions to boost the economy. The central bank's stance to protect the yuan as it loses strength is reaffirmed by Friday's announcement, but Chung noted that it was unlikely to reverse the bearish picture of the yuan. The policy change on Friday also comes as China ramps up attempts to strengthen the yuan by consistently issuing firmer-than-expected daily advice, and even requesting that some domestic banks reduce their overseas investments as authorities grow increasingly uneasy with the currency's accelerating decline. Economic experts favor policies that would increase the GDP share of household consumption. Government-funded consumer vouchers, large tax reductions, promoting quicker wage growth, constructing a social safety net with greater pensions, unemployment benefits, and better, more accessible public services are some alternatives. A recent Communist Party leadership meeting did not discuss such actions, but analysts are anticipating more significant structural adjustments at the party conference in December. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comments section below.